Hello everyone, it's Marshall Gittler for Claws and Horns, bringing you the week ahead for the week beginning 3 July. The major theme in the market nowadays is monetary policy normalization. Over the course of just a couple of weeks, several of the central banks that seem to be on hold indefinitely have warned that they're likely to start normalizing policy at some point. The ECB, the Bank of England, and the Bank of Canada, for example. The idea may be that if several of them do it at the same time, then relative interest rates will remain unchanged and the change will be less disruptive to the markets. Now this is negative for the dollar. Up to now, the Fed has been the only major central bank that started shedding the extraordinary monetary policies that it enacted following the great financial crisis of 2008. That's driven the monetary policy divergence trade up to now and contributed to the strength of the dollar. As you can see from this graph, the dollar was relatively weak during the period when the Fed was carrying out its quantitative easing program. But after then Fed Chair Bernanke made his famous speech in 2013 foreshadowing the end of that program, the tapering of the QE program, the dollar has firmed up considerably. The problem is, the Fed's tightening policy is pretty much discounted by now. The difference between the longest Fed funds futures contract and what the FOMC members forecast as the long-run equilibrium level of the Fed funds rate is now only about 125 basis points, meaning the Fed's about halfway through its tightening program. By contrast, other central banks have a lot more room to raise rates from here. And to make matters worse, the debate in the US is whether rates should have to rise more slowly than the Fed forecasts. In other words, whether the Fed may have to pause in its rate lifting program. By contrast, the debate elsewhere is about whether central banks might have to raise rates earlier than expected. That's also to the dollar's disadvantage. The focus then during the week is going to be on three events. First is the Reserve Bank of Australia meeting, the only central bank meeting on the major central bank meeting on the schedule. Second will be the usual attention given to the monthly U.S. non-farm payrolls data. Finally, the G20 meeting may provide some direction for Eurodollar. First, let's discuss the RBA meeting. The market still sees a very small chance of a rate hike this year, only about 13% probability that rates are raised by the December meeting. But still, that's up from only about 3% probability a week ago, when the market saw a 5% chance of a rate cut by the end of the year. Now the chance of a cut has all but disappeared, and the probability of a hike over the next 12 months has risen to 84%, i.e. almost certain. Now, given all the talk about normalizing policy, the market will be keen to see if the RBA too participates in the trend. I tend to think not. I expect them once again to keep their bias unchanged, as they probably don't want to push the currency any higher. But it's possible that they could do so, in which case the Australian dollar would probably strengthen further. The non-farm payrolls are, as usual, likely to be a major event. The forecast for the ADP report and the NFP are both around 180,000, which would be fantastic. Remember that in August of last year, Fed Chair Yellen said gains of that magnitude were unsustainable. Yet, here we are today. The unemployment rate is expected to stay at 4.3%, which is already below the 4.5% to 4.8% range that the FOMC considers to be normal over the long run. Now, given that the Fed has clearly met the first half of its dual mandate, namely full employment, I think the focus will be on average hourly earnings and the average weekly work week. That's because the big debate is not about employment per se, but rather about inflation. Committee members want to see a tighter labor market feeding through to higher inflation to be sure that they'll meet the second part of their dual mandate, namely stable prices. In that respect, the forecast acceleration in the growth of average hourly earnings could be positive for the dollar. As for the G20 meeting, these usually don't produce that much in the way of fireworks. But after seeing the big differences on display at the G7 summit recently, we can only guess how this one will work out. Germany's Chancellor Merkel hasn't tried to hide the split in views, particularly concerning trade and the Paris Accord on global warming. On top of which, Trump will meet with Russian President Putin, a meeting with major implications for domestic U.S. politics. From the FX market's point of view, the focus will probably be on whether they retain their opposition to protectionism and refraining from competitive currency devaluations. It could be that Trump insists on throwing those lines out, which I think could hasten the dollar's decline. As for the data, the main point will probably be the final market purchasing managers' indices for those countries that have already announced them, such as the EU and the US, plus the closely watched ISM indices in the US. Now, Germany announces its factory orders on Thursday and industrial production on Friday. These are expected to show a continued expansion, which may help boost the euro. There's some significant news out about the UK during the week, including their purchasing managers' indices, plus industrial production and trade on Friday. The IP data are expected to show a relatively healthy domestic economy. The trade figures are the Achilles heel of the UK economy nowadays, but here the message may be a bit better than that. They're forecast to show a wider trade deficit than in the previous months, but nonetheless a slightly narrower deficit than the 12-month average. That could be positive for the pound. Finally, first thing Monday morning, Japan releases its closely watched Tankan survey, the Bank of Japan's short-term survey of economic conditions. It's forecast to show an improvement in sentiment almost across the board. That could prove positive for the yen, unless, of course, it proves positive for Japanese stocks, in which case the yen might actually weaken because of the relationship between the yen and the Japanese stock market. This is Marshall Gittler for Claws and Horns, bringing you the week ahead for the week beginning July 3rd. Wishing you good trading.